Good morning and welcome to Palm Springs Life Market Watch. I'm Tally Fantini with Palm Springs Life. Our corporate sponsors for today are Sunrise Company, Toscana Country Club, and Andalusia Country Club, Franklin Loan Center, Palm Springs Regional Association of Realtors, and California Desert Association of Realtors. Today's seminar was initially intended to be an in-person seminar. However, due to the restrictions placed upon us because of COVID-19, we've transitioned into a virtual event. I'd like to thank our great speakers that we have today to cover an important topic. COVID-19 changed everything. What's the outlook? What should you do? Our speakers for today are Mike McDonald with Market Watch LLC, who will discuss changes in home prices in the Coachella Valley, Los Angeles, and Orange counties. Walter Neal with Franklin Loan Center, who will discuss changes in the mortgage market, and Brady Sandall Group with the Brady Sandall Group, named Palm Springs Life Top Realtors, Top Real Estate Group, who will discuss opportunities for agents, buyers, and sellers. Without further ado, we're going to go ahead and get started. Mike, I'm going to hand it to you.
Thank you, Tally, and good morning, ladies and gentlemen. March 19th, the start of the quarantine, was the day everything changed in the Coachella Valley. Up to then, all the housing metrics were at record levels, and we were expecting a terrific year. So the key question I will address today is what has happened to the market since that date? What has happened to sales, prices, and inventory, etc., and what's the outlook? To fully answer these questions, we had to develop new ways to measure the market, since the normal metrics assume markets are changing slowly over time, over many months, but that's not the case now. Markets and conditions are changing daily. So we had to develop metrics to show day-to-day changes, and all the charts you're going to see today are daily charts. We're going to show you what happened to sales, prices, inventory, price discounts, and days in the market over the last year and since the shutdown, not only for the Valley, but the larger markets of Los Angeles and Orange County as well. This way you'll get the complete picture. We'll explain everything as we go along. The first chart I'm going to show you are sales. But before I do, I want to give you a little message from us. Once this is over, ladies and gentlemen, we'll be back stronger than ever. We always are. So don't frown. We want you to keep your doober up. What's your doober? Well, I think you know what it is. So keep it up. Okay. Now we're going to get to the sales chart that I was talking about. And I'm going to spend some time orienting you on this chart. There's always an X and a Y axis, and it takes a little familiarity to fully understand what those are. But once you do, then it goes quickly. And since a lot of the charts are exactly like this, time spent here is going to be valuable. This is 1 year of time. Each little hash mark is a month. In between are the daily changes in whatever we're looking at. It's a daily, measuring on a daily basis. In this case, we're looking at average daily sales for single-family residences for the entire Coachella Valley, all 9 cities. Over here is 5 days, average of 5 daily sales a day, 10 daily sales, 15, 20, 25, 30, okay? So that's this scale, that's the time scale. And pending sales really are the number of homes that are entering escrow every day on average. And this is the daily plot of that. And over here, by the way, in every chart, we're going to show you Governor Newsom's quarantine order, where it occurred, and therefore you can follow what exactly happened to each metric from that date forward, okay? So now the interesting thing is that we generally don't spend time on pending sales. It's not very useful because, as we mentioned, sales slowly change over time, and what happened in pending sales has very little value, except now it does, because here in the Valley, pending sales or homes going into escrow period is about 14 days. So it at least gives us a 14-day window into what closed sales are going to be, which is now very important. So this is a picture of pending sales going back. A year ago, it was 22 units, okay? A day, I'm sorry, and 11 units now. So pending sales are down 51.9% from a year ago. Notice though that it might be flattening out here. There's signs that the fall off in pending sales is going to kind of stabilize here at about 10 units a day, which is very positive, okay? Now, let me show you why pending sales are useful, because now I'm going to superimpose over this chart closed sales. And you'll see, there you go, this lighter green line is closed sales. And notice pending sales moves before closed sales, as you would expect. Obviously, pending sales, not all of them, the vast majority go to close in about 14 days. So that's why it leads. And now you'll see the value. Let me do something real quick here. I want you to study the chart. I'm going to show you why pending sales are valuable, because I'm going to move this pending sales curve forward in this direction, and you'll see the value of its forecasting ability. Now watch carefully. See that? I'll do it again. There, okay. Now we've actually moved pending sales up 2 weeks. So in other words, on May 15th, this data, by the way, was all as of May 1st. So by May 15th, we should expect closed sales, which are currently 12 units a day, should go to 11. So already closed sales is rapidly approaching pending sales. And you can see that the forecast here is that it's not going to drop for much more over the next couple of weeks. In other words, 12 is pretty close to 11. So that's a positive. Now, again, this is for single family residences. Let me show you for condos. It's a slightly different picture. There's condos, same curves, okay, but this is for condos, not single family. And here, pending sales have dropped to an average of 3 a day. Current closed sales is averaging 5 a day. So that's a 63% drop in pending sales compared to a year ago. So pending sales are down a little bit more. I'm sorry, yes, condo sales are down a little bit more than single family residences. Now I want to show you a little historical or an out of area picture, LA County and Orange County, so you can compare how our market compares to these other larger regions. So I'm going to show you the same curves, but for Los Angeles County. Here's LA County. Whoops, there we go. LA County. Now, LA County is different in that escrow period, instead of being about 14 days, is now 35 days. Now, this is kind of interesting. One of the reasons we've come to conclude as why Coachella Valley has a much shorter escrow period versus LA County and Orange County is because there are so many cash sales. I believe 70% of all transactions are cash purchases, which shortens the escrow period. Walt will have the exact numbers because he's right in the middle of that. So notice here that LA County a year ago was 166 average pending sales a day, down to 44 or 45. It's currently closed sales are 99 units a day, so we can expect another 50% drop in closed sales over the next month. And pending sales are down 73% from a year ago in Los Angeles County. How about Orange County? Orange County down 79%, all the way from 86 units a day down to 18. Closed sales are 49. So you can see the forecasting ability that monitoring pending sales during this coronavirus crisis, there's a very great use there. So now I want to go to prices, because everybody's saying, what's going on with prices? Is there any change there? Well, I think you'll be kind of happy to see. Oh, I'm sorry, before I get to there, I want to talk about pending sales by city. Okay, we've got here single family residences. Instead of for the region, these are the regional numbers. These are the city numbers. This is the May 1st pending sale numbers for the city, each city, a year ago number. Okay, May 1st again for condos, etc., and all homes. Notice 55% reduction in pending sales for the entire region. Some cities, though, specifically Palm Desert, Palm Springs, and Rancho Mirage, are closer to 60% drop in pending sales. Other areas, for example, other cities, city of Coachella is down only 30%. Indian Wells is only down 28%. Cathedral City down 50%. So this shows the breakdown of pending sales compared to a year ago for single family condos and totals, okay? Now prices. The best metric to show you for prices is not actual median price, but price per square foot. There's a reason behind that, because there's less variation between price per square foot than there is median price due to statistical aberration. So this is the best metric to use when you want to compare price changes. So a year ago, now this is for single family residences. This is the average price per square foot for the entire Coachella Valley. It's a composite of all 9 cities. A year ago, it was $244 a square foot. Currently, it's $238. Here is the Newsom stay-at-home order. So there's been a slight downward bias here, not much. Okay, it was, well, let's say 250, 255, now down to 238. Some of this is seasonal. Some appears to be due to the coronavirus. It's hard to tell how much. Now, this again, single-family residences. Let me show you for condos. Here's condos, the same picture. We put a little question mark here specifically because we're not sure if this price weakness here is due to the coronavirus situation or a seasonal factor. It could be a little bit of both. It's going to take a little bit more time to tell. Condos are doing better year over year. It's 204 a year ago to 216 now. And we're actually, I think, a little bit above where it was during Newsom's order, or it's just about the same. There's not much change. So for this market, the condo market, there's very little price impact from the coronavirus. Now, let's take a look at the city changes. Again, okay, for the single family residences for the entire region, 238 on May 1st. A year ago was 244. March 19th, 253. So for the region, we're down about 6% since the quarantine for single family residences. For condos, we're actually up 1.9, almost 2% since the quarantine. So this just confirms what we saw in that other chart for the entire region. Now let's take a look at inventory. This is very important. About a month ago, a little over a month and a half ago, we started keeping track of the daily inventory. We figured this would now be useful. Normally you just have to look at it maybe once a month, but now because of the coronavirus, we started keeping track of daily inventory, and we've plotted it over here on the right for the last month and a half. These are extrapolated daily values going back. On May 1st, there were 2,924 units available. If you go back to March 19th, it was 3,019. So it's just a small decline of about 100 units over this period of time. Very little change over the last 2 months. A year ago it was 3638. So inventory remains very, very contained. Let me use that word. That's a very good word for this. There is no rush to sell or put the homes on the market at this point in time. And that's a very positive factor at this time. Now, let me show you one of the reasons why inventory is not increasing, not the only reason. And we have a chart here showing the number of new listings on average coming to the market every day. Okay, and the number of canceled listings, which is down here. So this is new listings on average a day, canceled listings on average a day. And we put here a little interesting pattern. You'll find this every year. It's rather interesting. There's a yearly seasonal listing slowdown between Thanksgiving and mid-January. There's this little dip here. This dip was not due to anything else except a seasonal trend or pattern. And if you go back in time, you'll see that same pattern every year. But one of the positive things here, that one of the reasons the inventory has not been going up is because of this. People have been not putting their homes up for listing. There's been fewer and fewer new listings, and this narrowing between these two curves, it's not the sole reason, but it's probably one of the major reasons why listings are not going up, even though sales are down. Normally, if sales are down, people throw their house on the market and the absorption rate is not high enough and inventory goes up, but that's not the case now. So this is a very positive situation here. Now I want to go to an important metric called days in the market. Average days in the market for the entire Coachella Valley remains stable. These are the average number of days it takes to sell a home throughout the whole Coachella Valley on a daily basis. Okay, here's the quarantine order again. Currently it's 78 days on average. A year ago it was 76. So there is no sign of any kind of market disruption due to the coronavirus from this metric. Now this is days in the market of closed sales, okay, not the days in the market of the outstanding listings. And this is for single family residences. Let's take a look for condos. Here's for condos, 70 versus 68, same pattern for condos. So there is no problem at all in this metric. And now for discounts, have sellers been giving up price to try to sell their home? No, they have not. That's very positive. Single family residences, this is the average percentage discount throughout the valley. A year ago it was 3% for single families. Right now on May 1st, 3%. Here's Newsom's order. There's no sign of any problem here from this metric for single family residences. How about for condos? Condos, pretty much the same pattern, not much change. There is no sign of a problem here for with price discounting, okay, which is positive. So I want to summarize here. Summary as of May 1st, pending sales in the valley are down 55%. It looks like this might be stabilizing, which would be positive. You know, one can imagine in their mind that with nobody going out to see open houses and, you know, this quarantine, that sales will go to zero. It's not. So there seems to be a bottom here of around maybe 10 units a day. And now with the reopening of the situation, I think that's going to be the bottom, hopefully. Condo sales are off more than single family residences. Inventory is not increasing yet. Hopefully they won't, all right? You only get into trouble if the market gets disrupted and people put their house on the market and there are not enough buyers to absorb it and inventory kind of gets carried away. We're a long ways from that consideration. Don't worry about that. There's no sign of that at all. Prices have a small downward bias though. It's hard to tell if that's real or if it's just a seasonal factor. More time's going to be needed to take a look at that. Days in the market and price discounts are also stable and currently in normal ranges, so we don't have to worry about that. The shutting down of the consumer economy. Ladies and gentlemen, we have a very advanced economy, one of the most advanced in the developed world. Used to be, going back to 1900, 30% of our economy was service, 70% was farming and production. Now it's completely reversed. 70% or more of our economy is service oriented. Only 30% has to do with the production of stuff, things, you know, shoes, clothes, cars, etc. This is a very interesting situation because never before has the economy been intentionally shut down. Remember, this shutdown did not occur for economic reasons. It's a man-made recession as an outgrowth of a medical issue, okay, with this coronavirus. But it was like someone just turned the switch off. Say, okay, stop. And it was stopped. That can go on for a while. If it goes on too long, though, you can cause some permanent damage. So this ending of the shutdown is important. The question, though, is very important. Will the consumer restart when the quarantine ends? Is there residual fear in the consumer's mind where even though all the stores are open, et cetera, people don't go there because they're still scared to go out? That remains to be seen. We think it'll be a little blending of that. It really depends on the leadership we get and the information we get and any kind of medical issues or solutions that come up that's going to give us confidence that we don't have to worry anymore. We can come right out of our shells and get going again. And so we can't tell yet if there's any lasting damage to the consumer psyche. One of the benefits that we see here is that real estate should be an early recovery industry. Not like restaurants or movies. People won't go to restaurants or movies because they're going to be around other people. They're going to be afraid of catching things. And you can't eat if you're wearing a mask. Those industries have a great difficulty. Same with the tour industry, the travel industry. Real estate, though, is completely different. People need homes. They have to either buy or sell homes. They don't have to be around other people when they're doing this. So I think you're going to see the real estate industry come back much more vigorously than other industries very, very soon. So that we think is a positive. No forecast, unfortunately, is currently possible under the current situation. We will continue to closely monitor the situation for you. Nobody can forecast what the economy is going to do right now. It's dependent too much on the medical situation. We need more time. We'll keep track of it. So hopefully, ladies and gentlemen, this presentation presented some facts, some numbers to think with so you can kind of figure out what's been going on. A lot of people have been a mystery. without any numbers to look at as to what's happening. Hopefully this filled that vacuum. And so that's the end of my presentation. And I want to now introduce Walter Neal, president of Franklin Loan Center. He's going to be talking about the mortgage situation. There's a lot of things going on there that you should be aware of. I've heard this presentation. Don't miss it. He goes through all the factors. So Walter, take it over. Thank you.
Thank you, Michael. Michael, you do such a great job getting out on-time current facts for our local community, for the real estate community that they can share with their buyers and sellers. And Michael, you're 100% correct that since we've been tracking cash over the last 10 years, it's around 60 to 70% of the buyers are paying cash. So that's always been my biggest competition as a lender, trying to get people to want to finance. So those numbers are absolutely correct. So thank you for that. Well, good morning, Market Watch family and friends. It feels a little unique to be doing this sitting at my desk. I do like to be standing up, walking around, seeing all your beautiful faces. But under the current situation, this is what we have to do to get the information to you. So this is what we're going to do to add value. Hopefully this presentation to you will be valuable. I'm going to go through several topics quickly. So looking forward to adding value and hope you all have a healthy and joyful May and the rest of your summer. My first slide here is a Rubik's Cube. Everyone has seen a Rubik's Cube before. The reason I chose to use this is because when you change a Rubik's Cube one time, all 6 sides change. And I feel like the economy we're in is a Rubik's Cube economy. One thing changes, it affects 6 different things. I'll take it a step further. I'll call it a fluid situation, something that is unstable or subject to change. So let's take a walk down memory lane for the last 60 days so I can talk about some of the things that happened and how that may have impacted you, your clients, or maybe how it may impact you guys moving forward. So on February 19th, the S&P 500 reaches an all-time high. Everything was moving along great. Everyone was happy. Business was awesome. Our first sign was a crack in the dam. So picture a dam with the water going over the top. That's a dam that's successful. But imagine a little water coming right out of the middle of the dam. The first crack in mortgage-backed securities was basically the mortgage-backed security bond market saying something's not right. A day later, the NBA suspends their season. 3 days later, the Federal Reserve did something they never have done before in history. They came out historically on a Sunday for an emergency meeting announcing support to the economy. So that is something that was never done. When those 3 things happened, I thought to myself, oh boy, what's coming? 3 days later, and the reason I've got this highlighted in red is this is going to be the meats and bones of my presentation today. The government came out and announced forbearance for 60 days in suspension of all foreclosure on government loans. So they came out and made that announcement. A lot of people had never even heard the word forbearance. So everyone's started searching on the internet, what's forbearance? What's going on? A day later, March 19th, California went shelter in place. Once again, very unique. A day later, March 20th, non-QM suspended business. This was the type of business that successful self-employed borrowers are using to get mortgages. This was for people that had stated income. This was a big driving force. About 10% of the market was using this product. It went away overnight. 2 days later, March 22nd, which is only a month after we hit an all-time high, the S&P had dumped 35% of the market value, which is a huge eye-opener. And people started to get very, very nervous. March 23, the Federal Reserve came out again with an announcement, and they called it quantitative easing unlimited, which basically meant they were going to buy mortgage-backed securities to keep rates low and treasury bonds to keep putting capital into the market, which they've never done before. They never did unlimited. They always came out and said, we'll do 200 million or 200 billion or 300 billion. But they came out and said, we're taking the gloves off. We're going to do anything we need to do to support this economy, keep people interested, unemployment low. March 26, 3 days later, FHA and VA product started to tighten. You started to hear banks not wanting to lend on FHA and VA loans, which I'm going to get into more later. And then 1 day later, the CARES Act was passed. And the CARES Act made an extension of the announcement. It was no longer going to be 60 days of forbearance. They came out and said if it's a government-backed loan, it's going to be a year of forbearance. So that was a huge shock to the market. And I'll tell you why in the further presentation. April 3rd, you guys all remember this one clearly. As realtors, your business became essential. That was a huge boost to sellers and buyers that they could interact in business a little bit more freely. April 10th, Ginnie Mae came out with servicing relief, which was a huge boost to the secondary in the mortgage market. I'll get into that on April 10th. 10 days later, oil goes negative. We've never seen oil go negative in the history of this country. It went negative. A lot of people are asking questions, how can that be? Well, that's something for us to talk about as well. April 21st, Ginnie Mae came out with servicing relief. I said on April 10th. On April 21st, FHFA came out, which is basically Fannie Mae and Freddie Mac. But I'm telling you guys, this was a D-, and I'll get into that later as well. On April 24th, cash out refinances started to come under pressure, and I'll get into that why later as well. April 30th, 2 months after we were moving along, everyone's happy, business was doing great, unemployment 17%. 17% of people of this country were out of work, which puts a lot of pressure on the mortgage market because you need to have a job to make your mortgage payment. And then on May 1, there was an announcement that most people doing HELOCs were suspending them. If you don't know what a HELOC is, that's a home equity line of credit. If you remember back to the last recession, home equity lines of credits got suspended in like 2007. Well, the fact that they're starting to suspend those is also a negative sign about maybe what's to come. So that's a trip down memory lane. I know a lot of you remember those things. Let's talk about what that timeline means to you, the mortgage industry, and why that's important to your sellers and buyers. So let's start with forbearance. What is forbearance? The simple definition allows borrowers to temporarily stop making payments without risk of foreclosure, but missed payments are typically due in a lump sum. So we're going to come back to that. Now, who qualifies for forbearance in this market? I'm going to use a 70-30 analogy here for you, because the people that qualified for forbearance were people that are federally owned or government-backed loans. And what are government-backed loans? Fannie Mae, Freddie Mac, FHA, VA, USDA. Right now, 70% of all mortgages are federally backed by those entities. So anyone who has one of those mortgages has the right to ask for forbearance and must be given forbearance. Well, what about the other 30%, Walter? Well, the other 30% are privately owned notes by individual investors, maybe not government backed. They are not guaranteed to get forbearance. That is going to depend on the servicer who is servicing their loan, which we're going to get into later. Okay, so if they do qualify for forbearance, it's 180 days on a government backed loan with 2 90-day extensions. So you can actually go all the way up to a year not making your mortgage payment. But let's talk about what forbearance really is and the impact it has. So forbearance, do you have to provide a hardship? No, it's on the honor system. A lot of people are looking at it as a mortgage holiday and there's no hardship being documented. That's a mistake. And that mistake is going to cost some people missing out on the opportunity to buy. And I'm going to get into that later. Who should use forbearance, Walter? Who, if my clients are asking me, my friends are asking me, only people who have lost their job and have no reserves in the bank should consider a forbearance. And I'm going to get into that a step further in some later slides and why that should be the case. Well, what are the consequences of the system being gamed? What are the consequences of people who have reserves, who haven't lost their job, taking advantage of the system and asking for forbearance? Well, for us to understand the impact, we need to better understand the system so that we can all judge the consequences for all of us moving forward. So to understand servicing, we need to look at what the basic setup, the model of servicing is. So if you look here on the right side here, you've got borrowers. Those are people who take out mortgages. And when you take out a mortgage, you sign a note based on terms and you pay on those notes based on terms. But when you make those payments, you pay those principal and interest payments to a servicer. That servicer then takes your principal and interest payments for a borrower and they deliver it to the note holders, the people that own the loans. And the majority of the loans that are owned are by government-sponsored enterprises down in the corner, which is Fannie, Freddie, FHA, and VA. And FHA, VA, and Freddie, they don't service their own loans. Someone has to service the loans for them. And so what does the servicer do? Well, the servicer gets a fee for being the middleman, for being the accounting system, and then they then communicate back to the borrower. So you've got a borrower, you've got a servicer, and you have the note holders. So let's look at the basic setup of a servicer and why a servicer is important to you, for your business, and for the future benefit of buyers, sellers in the mortgage business. Well, what's the opportunity of a servicer? The servicer buys the accounting rights to an investment. They pay 1.5% of the unpaid principal balance of every loan they buy the rights to service. So on a $100,000 loan, a servicer pays $1,500 to have that right. Well, that's their opportunity. That's what they invest. What is the income they get? Well, a servicer gets about $250 a year back on that investment for every $100,000 of unpaid principal. Okay, so if they're paying $1,500 up front and they get $250 back a year, it takes 6 years for a servicer's investment to break even. So this is a long-term gain that servicing is supposed to be. So what's the risk to a servicer? This is what I want to drill down to in this presentation so you understand how to advise people the importance of forbearance. The short pay or no pay. So if someone who has a mortgage decides not to make the payments or short pay, the servicer has to make the full payment or the portion of the payment that wasn't paid. And I'm going to tell you why that is such a negative thing for everybody who's going to ever buy or sell a home in the next year or two in mortgages. What's another risk to servicers? EPO, early payoffs. Mortgages typically are held long-term. That could be a negative to a servicer. The other thing is the overhead, the operating expense. So now that we understand what servicing is and how it's set up, let's talk about the consequences to forbearance to a servicer, which is vital to the mortgage business succeeding. So I'll use a servicing portfolio in this example of 1.5 billion, which is a very small servicing portfolio. Let's say of that portfolio, 20% of people say, I'm not making my payments, regardless if I can, or regardless if I don't want to, or maybe I really can't because I lost my job. That's $200 million of mortgages that no longer are being paid for, that the servicer now needs to front the payment. So what kind of numbers are we talking about, Walter? Well, that'd be $955,000 a month in principal and interest, $210,000 a month in property taxes, and $59,000 a month in insurance. So a servicer who their job is to be the middle man between the borrower and the note holder is going to come out of pocket for $1.225 million to cover the forbearance of the people who have asked for it. Or if you look at it yearly, $14.69 million. This is a small servicer, but these small servicers are required in the marketplace to be able to handle the capacity of the business. To give you an idea of a big servicer, you've got Wells Fargo, 1.17 trillion. So imagine just taking these numbers and times them by thousands. That's what Wells Fargo is fronting. So let's talk about the second part of forbearance, the repayment options. There is a lot of misunderstanding in the marketplace. I get on Facebook, I get on Instagram, I read articles. People are putting bad information out there. I am here to set the record straight so you can advise your clients and advise people when to take advantage or not take advantage of a forbearance. The truth around the repayment options, it's fluid. It's changing daily. And it depends on two things. One, it depends on the 70-30 rule. Who is backing your mortgage? Not who owns it, but who's guaranteeing that mortgage. If it's one of the 70%, you have the right for it. Okay, but the payment options depends on the servicer as well, how you're going to pay it back when you come out of forbearance. So what are the most likely options your clients would have when they come out of forbearance? Well, there's two options. One is a lump sum. That's the most common option, and that's what's typically been done in the past. But how is a lump sum going to help people who've still currently unemployed, or maybe they're back employed, but only maybe at a 50% capacity? So their income's still 50% less. So they don't have the money still to make their full payment. How's that going to help them on a lump sum? Well, that probably won't help them. So the option, if the servicer gives it to them, if it's one of the 70%, they'll give it. But if it's one of the 30%, they might not get this option. And that's a loan modification. Now, what is a loan modification, Walter? I'm glad you asked me, and I'm going to explain a loan modification. And this is to the heart, something everyone needs to be getting out to the community. The definition of a loan modification is a change made to the terms of an existing loan by a lender. It may involve a reduction in the interest rate or principal, an extension of time for repayment, a different type of loan, or any combination of the three. The one I want to focus on here, which is important to our current situation, is an extension of time for repayment. That's what people are going to need if their income is down or they're out of work. Okay, so here are some basic questions that I'm going to answer for you that you can then let other people know the facts. Will it hurt my credit if I do a loan modification or a forbearance? Yes, it will. Will it show a mortgage late payment? No, it will not. So that right there is the core of the issue. Everyone knows it won't affect showing a mortgage late, which is correct, but it will affect their mortgage. And let me tell you why. Will it lower my FICO scores? Yes, it will. Will it adversely affect my ability to borrow money? Yes, it will. Forbearance isn't free, and it will negatively impact your credit and should be a last resort to a short sale or a foreclosure. Should be a last resort to a short sale or foreclosure. And the reason why a loan modification is going to affect your credit is it's going to be reported as a loan modification. That loan modification will be a dig, not a late, but a dig, just like a collection on your credit report's a dig, okay? Just like a tax lien is a dig. That's a public record. Someone's going back and doing a modification to an agreement that they put in writing. So it will affect you. So now that I've explained forbearances, loan modifications, there's some good that has come out of COVID-19. And there's some good that has come out of, unfortunately, some people being out of employment in forbearance support. So let's talk about some of the good here. Then we'll talk about some of the bad. The good, low rates. Today is a great time to refinance for people to save life-changing money for the rest of their mortgage on a refinance. If you ask me, Walter, well, where are rates? How good are rates? Well, here's a slide that goes from April 2016 to April 2020. And you can see we're at 3.125% on a 30-year fixed for good credit-worthy borrowers, okay? Not for all borrowers, but for good credit-worthy borrowers with jobs, 3.125. You can see the closest we've gotten to this rate was back on April 2016 at 3.42. The next question you might ask me is, where does this rate stack up historically, Walter? That is an all-time low. We've never had lower 30-year fixed rates than that. So this is a huge blessing for people to be able to take advantage and save some money. What other good things have come out of this? There's appraisal relief. A lot of people are not having to get appraisals on their loans, which not only saves them money, but makes the process go smoother. There's also drive-by appraisals that are being offered. There's also exterior-only inspections that are being offered. There's also desktop reviews that are done on computers on a desktop, like I'm coming to you from today, a desktop presentation. Okay, but you have to make sure the borrower qualifies for the product because not all products offer this. This is only on that 70% number. There's SBA loan payment forgiveness, giving relief to people that have mortgages on their businesses. There's been a stimulus package giving money back to affected people that have lost their jobs or affected businesses. The Federal Reserve has had aggressive monetary policy. I talked about the QE program. They're doing historically things here. The unprecedented things never been done to support this industry. And I'll get into that a little bit further as well. In Congress, congressional fiscal policy has out with the CARES Act. So there's some good that has come out of that. What is the bad? Well, based on some of the unemployment and the forbearance negatives, all borrowers are ultimately going to be paying the price, all future borrowers, until we have a full recovery. And I'll talk about a full recovery as well. And why do I say all borrowers? This forbearance piece is going to affect borrowers, and the unemployment is going to affect other borrowers. How? The mortgage credit's tightening. The box is shrinking. People that could buy a home 1 month ago are not going to be able to buy a home today. So that's unfortunate. They'll be able to buy again, but when that time comes, we have to have the market recover. And why has it become more difficult? Higher FICO scores are required. Banks are wanting people to have better credit worthiness, lower debt to income ratios. People are not allowing you to qualify with more debt and less income. They want less debt and more income. They want bigger down payments, more money down, and they get a lower loan to value. So that makes it difficult for some people. Cash out refinances. You're going to hear some of your clients talking about the fact the rates are higher. They're seen as a risky investment right now because in the last recession of 08, 09, 010, people were really in 05, 06, people started taking all the cash out of their homes. So then when the market collapsed, people just walked from their homes. So banks aren't going to let people do that again. They're going to protect against that. Just like with HELOC financing drying up. They don't want people taking all the money out of their bank, out of their home and using it, because then if the market doesn't correct, then they're going to short sale, foreclose the homes. So that's something they're trying to safeguard against. Non-QM lending dried up. I told you about that product. That's for some really good borrowers that can afford to make their payments, but have a lot of write-offs and expenses on their tax returns. So some of these borrowers will be left out. This program will come back, but it might not be for another year. And then jumbo lending. Anyone borrowing over Fannie Mae, Freddie Mac, FHA, and VA loan limits, that lending's getting scarce. And the box is shrinking more and more and more. And last and not least, the VVUE challenges. Verification of employment. Typically that's done at approval. Now all lenders are doing it at time of funding. We need to make sure, because sometimes people are losing jobs between the time the loan's approved and the time we fund the loan. So I need the real estate community to be patient with lenders. If a loan's supposed to fund, we can't verify employment because people are working remote or home, or maybe someone who's verified it is furloughed. It's taking time to verify that employment. So we all need to be a little bit more patient in these times. So here's the good news, folks. I just outlined some negatives about some of your buyers and sellers moving forward in the mortgage industry. The good news is there's a Franklin Loan Center advantage. And I'm going to explain what I mean by that. Not all lenders are created equal. They're not. They're just not. The big box banks and the national mortgage bankers have turned very, very conservative. And there's a reason for that. Franklin Loan Center's ability to pivot quickly has allowed us to retain our wide variety of lending options. Okay? And that's because we have judged our own risk based on our own size. So when you're a big bank like Wells Fargo or Chase and you're doing trillions a month of mortgages, it's hard to control the risk because right now no one knows how many people are going to go in forbearance. Nobody knows how long it's going to be until the economy gets turned back on. All that uncertainty to a really big bank or really big banker makes them go conservative to protect their losses. Where a small and nimble lender like Franklin Loan Center is still doing a lot of the products that the banks and large mortgage bankers aren't doing. So let me give you some examples. A lot of your lenders you maybe worked with in the past aren't doing FHA loans under 680. We're still doing loans all the way down to 600. A lot of the banks out there as well will not do a conventional loan down to 620. They're at 700 now. I'm going to say 50% of the buyers are going to be below 700. That's a big buyer pool that's left out. Small mortgage bankers like Franklin are here to still lend to these people. 30-day purchase closings, we can still do them. Don't let people tell you it can't be done. 45-day refi closings can still be done. We have a bridge loan financing option, allowing people to take money out of a home that might take longer to sell because of the current COVID environment, but they want to buy something, take advantage of an opportunity that might not be here 90 days when things recover. Appraisal flexibility. We have approved and gotten in line with all the appraisal options. A lot of banks, even though the options there aren't approving it and doing them, we are. We're also still locking loans. There's companies out there, they're not even locking loans until the rate's approved, which puts your borrowers in an uneasy position because they want to lock their rate and they don't want to say your rate's this. If I got to wait a month until your loan's approved, then I'll tell you your real rate. No one wants to hear that. They need certainty. in these uncertain times. So what I'm trying to tell you is we say yes when others say no. You know, one thing I just thought of that's not on this chart, first time buyer down payment assistance bond programs, we're still doing them when no one else is either. So some good news and some support for you is we're here for you. So if you're getting no's, call us and let's see if we can give you a yes. So how can you help? The number one thing that you can do for the mortgage industry and for all future buyers and sellers getting mortgages and for all future customers who want to refinance their home is educate your clients on the downside of forbearance. That's the number one thing I need you to do. They should not be asking for forbearance if they have not lost their job. And if they've lost their job and they have reserves, they should still not be asking for forbearance. Forbearance is for those people who need it, not who want to take advantage of the system. This is vitally important as this message gets out. So please pass that message on. I would also like to leave in closing two more things with you today. One is the three-legged stool. The three-legged stool is something that has been used over and over time throughout history. It's been used in the financial markets. It's been used in the military. It's been used in the faith-based markets. It's been used in sports. So the three-legged stool today is this. The first piece of the stool, monetary policy. We need that piece to be able to recover. What is monetary policy? It's the Federal Reserve. The Federal Reserve is mandated to keep unemployment low, which they're trying to do their best to do, keep prices stable, and inject money into the system. They've done that with QE Unlimited. So check one, we've got. Second part of the stool, fiscal policy. What is that? That's congressional support. What is congressional support? It's Congress. What is Congress? 545 individuals that represent this country for the benefit of the country. Okay, 100 governors and 435 House of Representatives, and they passed the CARES Act, one of the biggest passes of support stimulus ever. So second part of the stool, check, done. What's the third law? It's the most important piece and the most vital piece for us to recover, and that is COVID-19 containment. We have to have something that encourages people, if they go back to work, if they go to the movie theater, if they go on cruises, they go on airlines, they go to birthday parties. You get the point that if they get sick, they won't die, that they'll just recover like a flu. We need a medicine that maybe doesn't cure it, but contains it. And if we can just get that, those three things, we're going to get recovery. And that's when you'll know the worst is behind us. So let's all pray as a collective whole for that third piece. I'm encouraged it's coming. I don't know if it's a vaccine that's coming, but just something that makes people feel better and not contagious. And last and not least, I'd like to share with you Franklin Loan Center's 2020 slogan. I hope this brings some encouragement and inspiration to you. I know it has for my company. It's marathon pace. That is our slogan. I wear it around my wrist on this band every day. And what does marathon pace mean to Franklin Loan Center? It means it's better to go at a pace on the right track than to go fast on the wrong one. That's John Maxwell. Direction and pace in life is more important than shortcuts and speed. Okay, taking it one step further. It's not about how wide you grow, but how deep you grow. If we all just take one step in front of the other, and we just keep moving forward at a marathon pace, we will all look back and be encouraged and inspired of our growth as individuals, our growth with family, friends, and as a country and as a community. So on that note, I want to encourage you all to be healthy and joyful throughout the 2020 year and think of this marathon pace. So on that note, I would like to hand this off to our third speaker, Brady Sandahl from the Real Estate Group. I've heard his presentation. It's insightful, and it's going to give you foresight to also feel encouraged and some words of wisdom to use to be more successful in 2020. Brady, take it away.
Walter, thank you so much. You know, I'm a raving fan of you and Franklin Loan Center, and I want to commend you for following what John Maxwell has to say, because we also follow the words of John Maxwell. And for those of you who have not been exposed to Mr. Maxwell, I highly recommend following John. He's got some great one-liners. I want to take the opportunity to thank those of you who chose to participate and listen to what we want to share with you. I also want to congratulate all of the agents who have shown up to list property, sell property, and bring buyers to close property. So congratulations on showing up during the crisis and bringing your clients to the properties, getting them open, getting them under contract, getting them inspected, and getting them closed. Also want to say thank you to our great affiliates who really do support the agents, support the sellers, support the buyers. So just want to take a moment to say thank you so much for showing up. You know, right now is a difficult time. We recognize it's a difficult time, and we have to make sure that we are continuously re-energized. And we have to remember that not only are people needing to be re-energized, but we have to make sure that we are constantly recommitting them to get into contract and get to the closing tables so that we cross the finish line together. And more so than ever before, we have to make sure that we understand that we are not in a bad market. As Mike suggested, we were set up for a very strong 2020, but we were then exposed to a health crisis. And that health crisis caused unemployment crisis, which caused an economic crisis. But ladies and gentlemen, we are not in a real estate crisis, and we may never see a real estate crisis. So I think we have to remember that we are not in a bad market. We are in a market with certain challenges. Those challenges include the closure of hotels and motels, the closure of short-term rentals, the closure of shopping malls and restaurants and the businesses. And with that, that means that those challenges create specific opportunities. And ladies and gentlemen, those are the opportunities that I want to talk about with you today, because those opportunities require that every single one of us need to be in the game. I want to make sure that all of you individually, you as a team leader, you as a manager or broker, you as an affiliate, we need all hands on deck now than ever before. I've said to many of you that you come to the desert primarily for the weather, but you stay because of the people. And ladies and gentlemen, we need to make sure that everybody is on deck. And I think there are three things we have to focus on right now. Number one, you need to have a strong mindset. You know, the first thought in your head is generally not a good one, especially now, but that second thought needs to be great. And if you are not in with the right mindset, then reach out, lean into people who are. Number two, you have to have a really good skill set. Most of you have been in the market for less than 10 years. Some of you have been in the market for more than 10 years. And if you've been in the market less than 10, you haven't seen a challenging market. We are in a challenging market, not a bad market, a challenging market. When you're in a challenging market, you have to increase your skill set. And the third thing is you got to have a high level of enthusiasm, right? High level of enthusiasm. And in working with Keller Williams, the largest real estate sales force the world has ever seen, I've had the pleasure of being on Zoom calls, Facebook Live with our ladies and gentlemen throughout the United States of America. And the one thing I've learned is that you have to show up with a high, strong, positive mindset, continue to develop the skill set, and maintain your enthusiasm. So I'm going to go into a couple things that I want you to know. Number one, in this challenging market, we have to know what to do. We absolutely have to know what to do. We also have to know what to ask, right? More than ever before, you have to ask questions first before you're given the opportunity or right to consult or talk. So we're going to talk about what you need to do, what you need to ask, and then what you need to say. Think of it as an analogy. This is almost like painting by numbers, right? We've all painted by numbers, maybe when we were young children, maybe when we were adults, but we've all painted by numbers. It doesn't take a high level of skill. It does take discipline. The outcome is predictable and the results are generally successful. So think of this as a paint by number system. Now, the first thing in knowing what to do is you have to know the market that we're in. I call it the market of the moment, right? Now, for the last 10 years, as Mike suggested and Walter commented, we've been in a market that's been primarily cash. It's been Walter's biggest competitor, cash. this is a different market, right? It is a different market. So we have to understand the market of the moment. And then we have to frame it against the market of the past. Now, most of us in California would suggest that the defining moment was around March 19th, the moment when California went on their stay-at-home order. That's the defining moment. And why that's important now is most of the people buying, not all, but most of the people buying today in the desert are not in the desert. They're coming from out of area, and those markets may be very different. So we have to understand that we've been on a high tide for the last 10 years. But our real estate market today has been impacted by three things. Number one, the health crisis. It is a crisis. Number two, the unemployment crisis. Unemployment is higher than I think it's been locally and definitely nationally. And thirdly, we're in an economic crisis. Those three elements, those three crises are going to affect the local real estate market. Now, when you're looking at the real estate market, obviously we want to look at things like how many properties went on the market, how many properties went under contract, how many properties went pending and closed. That's all important data. But sometimes that data is determined or giving us light to the market of the past. If we're looking at the market of the past and not looking at the market of the future, we're missing what's going on. So I need you to look at leading indicators, right? There's a joke in the industry that who knows the market first? Market changes, it's always the buyers. Who knows it second? It's typically the agent. Who knows it the third? Generally the sellers. Why? Because sellers look in the past and buyers look in the future. So your leading indicators would be things like, are you getting lead inquiries? Are you having showing requests coming in? You know, are you seeing the calls come in more infrequently? Those are leading indicators. Positively, I know in the last week for our group, we've seen more leads come in. We've seen more showings take place. We've seen more offers come in. We've seen multiple offers come in. So the leading indicators dictate that we may be out of the pothole for the near future. But remember, buyers will find things first. The temperature check should start with the buyers. And if you don't have buyers that you're working with right now, call another buyer's agent, call a listing agent, find out where the buyers are coming from, find out, you know, how are they getting here? How are they finding the property? How are they buying the property? Those are the good leading indicators. Now remember, when you're a listing agent or when you're a buyer's agent and we talk about pricing, we typically determine pricing from activities in the past. So if you're used to the MLS default of 6 months, we probably need to shrink that down to 30 days, 60 days. Look at what's been going on in the current market of the moment, more so than what happened in the market of the past. And remember that there are two markets we're in, and only two. Properties that are priced to, well, sit, and properties that are priced to sell. And so when you're working with a seller, you have to be very clear. Are they pricing themselves to sit, or are they pricing themselves to sell? And those are the only two markets that we're in right now. The skill set, and this is so important. The cause and challenge of any shift in a market is simply caused by the change of motivation between buyers and sellers, right? Now, yes, we did have an unfortunate situation where they put everybody at home. Unfortunate because it really shut down the economy. Fortunate because it's protecting our health. I understand it's highly controversial. I understand it, I get it. But the motivation for buyers and sellers is changing, right? And that's causing the shift in the market. Now, I'll tell you this, that we have to be motivated in order to find those who are motivated. And that means we have to talk with more people. We simply have to have more conversations with more people. And when you're having those conversations with more people, you simply have to ask more questions. We need to do less talking. We need to be the interviewer. We need to be the doctor. We need to be the person, like Keith Cunningham says, author of The Road Less Stupid. Treat your business like an emergency room. Check the vital signs. Check them more frequently. Look for the change of the pulse. Look for the change of the condition. But remember, we do have to talk with more people. We have to ask more questions before we're given the right to talk. The second skill I think you have to have is understanding the message of the moment, right? We've been programmed to have a script in our head, and that script really hasn't changed for many in the last 10 years. the market's been very good, right? People have listed, people have purchased, things have closed. But in the message of the moment, remember that the message of the moment will only make sense to the customer if that message connects with their big why. And to find their big why, that means we have to be comfortable asking more questions, right? Don't project your opinion until you understand what their motivation is. We also have to have the skill of being great at both ends of the transaction, right? That means our ladies and gentlemen who are selling, they have to be great at getting into the transaction. But we also have to be great at getting the transaction closed. Remember, real estate is a bit like an assembly line. We do the same things over and over again, and they're not that exciting. We're going to meet with the customer, and there's some excitement there. We're going to sign the contract, whether it's a listing agreement or buyer broker agreement. If it's a listing, we're going to photograph the property, activate the listing. We're going to show it, sometimes virtually more than physically. We're going to negotiate the contract. We're going to get it accepted, open escrow and title. They'll do the inspection, they'll negotiate repairs, they'll remove contingencies, and we'll close. Well, there are basically 8 defining moments in the transaction. And candidly, we have to make sure that we understand what the transaction is going to look like time and time again. Here's the good news. You can anticipate what's going to happen next. Now, when you're anticipating, we also have to remember that we have to bulletproof the transaction. We have to bulletproof it because in a market that has challenges, problems are bound to show up more so than not. So in a market that's shifting significantly, right, where you have to understand how to bulletproof the transaction, we have to accept the fact that problems are going to show up. So remember that you're going to do the deals with your head down. You're going to do the deals with your head down, but what our CEO Gary Keller said is you're going to save the deals when your head is up. So yes, put the head down, swim, get to the other side of the pool. But remember, in this market, you have to have your head up. You have to have your head up. The antenna has to be really high. And I'm going to leave you with one big quote that came from a book, Atomic Habits. And I think it's critically important we talk about it now. You know, if you've had the pleasure of reading the book, or you don't necessarily have the time to read the book, then know this one thing from the book, and that is we are never going to rise to the level of our goals. We're going to fall down to the level of our systems and our habits. And ladies and gentlemen, this is the time where we all have to reach out and support one another. This is the time where we have to help each other get on the same page. This is the time where we all have to focus on our systems and our habits. We need to collaborate. Yes, we need to represent our clients well, but we need to collaborate so that we can get ourselves into contract, get to closing, and get to the finish line. And I do believe, I wake up every day believing this, that we are a valley of phenomenal people, and we're a valley that will rise to the occasion. And it's my honor and privilege to be here today to help you rise to the potential and exceed it sooner than you thought you could. Thank you so much for being here. Thank you for letting me pour into you. And if you need anything, please reach out to me immediately.
Thank you, Brady. That was great. I'm going to bring back our other 2 speakers now for a brief question and answer portion. Hi, guys.
Hi, how are you?
Hi, Tally.
We've got some great questions. We'll start with this question is for Brady. Brady, I have a client who's thinking about selling. What would you say, or would you say this is a good time to sell, or should I wait? Or should they wait?
Certainly, it is a great question, and thank you for reaching out to your client base to talk about if they should sell. Candidly, right now, the market of the moment, if they have a specific need, if they're highly motivated to price themselves to sell, they should go on the market. But if they're saying things like, well, if I get my price, or they don't have the level of motivation, I would suggest not putting them on the market right now.
Thank you, Brady. Mike, this question is for you. Based on the data, do you see home prices going up or going down in the next quarter?
Oh, Tali, that's a very good question. without being able to actually figure out what the markets, the economy is going to do, that's hard to answer. But let me point out, all the data seems to support that prices are going to stay right about where they're at. And I want to bring some, I think, an important point up. A lot of people might be frightened that this might be a reoccurrence of 2007, 2010. But I want to point out that prices, home prices right now make sense. They're rational. Back then, prices were way out of line. So right now, they're at affordable levels. Actually, with lower interest rates, they're more than affordable. So there shouldn't be much downward pressure on home prices at all. But there shouldn't be much upward pressure either, because we don't have an onslaught of buyers, at least not yet. So I think one should expect probably home prices to stay right about where they're at right now.
Okay, great. Walter, this question is for you. Now that I have a better understanding of servicing, how can that impact my business?
That's a great question. Servicing, I'm going to give you an analogy. Servicing is like a CPA. In the middle of, you've got a borrower, you've got a CPA, and you've got an IRS. CPA is sort of the middleman in the IRS. If servicers go out of business because too many people ask for forbearance, they don't have the money to make the payments, and all of a sudden there's no CPAs left, then everyone has to service their own loans, which technically they can't do. So a servicer is a necessary step in the mortgage process. And I'm glad you brought that question up, because one thing I don't think I made clear in my presentation was the loan modification piece. When you go into a loan modification, not only does it affect the credit, but you have to make 12 consecutive on-time payments before you can actually go back into the credit industry and get the best rates. So it will affect your car loans, it will affect your credit card rates, it will affect your mortgage rates. So loan modifications will also affect your ability to borrow cheap money. So hopefully that answers how important the servicers are. Look at a servicer like your CPA.
Great, thank you.
Welcome.
Mike, this question is for you. What will happen if our service economy stays down until next year?
Okay, let's encapsulate that nationally or locally. Let's talk about locally, because the Coachella Valley really is a very heavy service economy with all the conventions and restaurants and all the amenities that we have out there. It's a very heavy service oriented economy. And with people not coming from outside the region, to visit their homes, et cetera, or coming with conventions, that industry is down, and it will probably stay down somewhat through the summer. But that's normal anyway, because we don't have much going on in the summer. So it's going to be hard to measure that. But next year, October, November, December, as we get into that period, we'll be able to see then if it picks up. And so let's put that answering that question off till later next year when we'll have more data about that. Okay.
Okay, great. This is an interesting question. It'd be great to hear from both Mike and Brady. Can you provide feedback on what the indicators I should look out for in terms of a worsening housing market?
Well, let me take that first, because I'm kind of the technical mathematical kind of a guy here. As far as indicators, I think of mathematics. The things that you really want to look at from an indicator point of view would be inventory. If inventory doesn't rise, that's generally a good sign. If inventory rises, that's and there's not enough buyers to absorb it, that can cause pricing problems later on. But we're not anywhere near that. So I would say, if anything, inventory would be something to look at very much.
And Mike, I think you're right. For someone like me who's on the front line of working with buyers and sellers every single day, I think the temperature check should be things like, as I mentioned earlier, how many calls are coming in, how many leads are coming in, are you getting requests to show your property, are you getting offers coming in? If so, where are the offers coming in at? Because I do think that if you focus on the buyer behavior, that is the best leading indicator. And then if you're seeing a slowdown in buyer activity, slowdown in showings and offers, then inventory will rise, then days of market will lengthen, then sales will slow down. What makes this situation so unique is we didn't choose to be in this situation. We didn't choose to have the state of California shut down. This basically happened so quickly that we were almost in shock. So clearly, we're already seeing new leading indicators where the phones are ringing more, the inquiries are coming in. So this is a great time to get back in the game because there are motivated buyers and sellers who want to do something, and it's your chance, right, and opportunity to help them.
Great, thank you. I think this question is for Brady. Could the pandemic drive people out of big cities into places like the Valley?
Well, this absolutely. I mean, we're already having people make offers on our listings who are coming from bigger cities like San Francisco and Los Angeles. And here's why. Number one, they've been trained that they can work at home, which means they don't have to commute from, one place to the other. They can physically work in a great city like Palm Springs or a great valley like Coachella Valley, and they can work in the comfort of their own home. I think number two is that people want to be away from the dense cities. They want more space. And candidly, they get more for equal or less money. So clearly, yes, we are going to see the benefit not only in the acquisition of real estate, but in our short-term rentals. I think people are going to come in and rent out those properties short-term and long-term for the fact that we're not in a major city.
Thank you. Walter, I have a client who is considering refinancing. Is this something she should do now or wait?
Well, no, I wouldn't wait. We are looking at historical lows with interest rates, but one thing that's important to understand is not every loan is made equal either. You might have a neighbor who got 3.125% on a refinance, and then a neighbor right next door got 4.25%. So it's all based on risk-based pricing. If it's an investment property or a second home, that's not going to have as good a price as a primary residence. If someone's credit score is higher or lower, that could affect the pricing. The loan to value, how much equity they have in their home, could affect the pricing. I mentioned earlier in the presentation, a cash out refinance, if you're taking cash out, might affect your credit. So the risk-based pricing makes every deal unique. And so no one should talk to their friends about what they got. They need to look at getting a custom quote tailored to their loan. But one really important thing to remember here is if someone is to call Franklin Loan Center to get a refinance, they're in forbearance on that loan, or let's say they own 4 homes and they only ask for forbearance on their primary residence and they want to refinance their second home. If they're in forbearance on any of their loans, they can no longer take advantage of these rates and refinance. They would actually have to call the lender, make their payments in full, and get the forbearance taken off the credit report because it's going to be shown on the credit report, just say Franklin Loan Center Mortgage in forbearance. So someone who has multiple homes, even if they're not in forbearance on the loan they want to refi, in forbearance at all will take you out of being able to take advantage of these low rates. Making sure another message that the real estate community gets out. But absolutely, now is the time to refi. Get a custom tailored quote to your situation.
Thank you.
You're welcome.
Brady, what are some of the success stories that you and your team have had lately?
Well, I think the first thing is just pulling everybody together, right? We have a phenomenal group of ladies and gentlemen who show up every day, virtually, of course, and they're reaching out to their customers, their current customers, past customers. We also took a look at where the buyers were going to come from, and we realized that the majority of the buyers were going to be in California. So we basically took the virtual tour concept, the Matterport, and attached it to our higher priced inventory to test the market. And we pushed that content out to markets outside of the Valley. And we did successfully find a buyer in Los Angeles who drove out to a home in Rancho Mirage, made the offer, and put it together. So remember, buyers are attached to their devices, cell phones, laptops, computers. And so we have to make it easy for them to purchase. So I would say, think about how COVID-19 is changing the way people buy and sell real estate. Their first showing may not be a physical one. In that case, it was a virtual one, and that led to the physical showing, which led to the offer that got accepted.
Fantastic. Thank you. Thank you all for sharing your insight and expertise. That ends our question and answer portion of the day. On behalf of Palm Springs Life, I'd like to thank our speakers, Mike McDonald, Walter Neal, and Brady Sandall. Once again, thank you to our sponsors, Sunrise Company, Toscana Country Club, Andalusia Country Club, Franklin Loan Center, Palm Springs Regional Association of Realtors, and California Desert Association of Realtors. Thank you to all of our attendees. You will receive a PDF of this presentation and a link to the recording within 48 hours. If we weren't able to get to your question today, we will send the answer in the follow-up email with the recording link. Thank you so much for joining us. Have a great rest of your day. We look forward to seeing you again on November 10th at the next Market Watch. Bye, guys.
Bye-bye.
Bye-bye.
Bye-bye.